Hey, good evening, everyone. Marty Mazzori here. It's the 25th of March, 2021. Just completed my very lengthy technical analysis where I go through every single position in our core mix of assets, sectors, commodity funds, etc. Also, about half a dozen currencies that we track on a regular basis and record on this spreadsheet that you can see on your screen. So, periodically I like to run through this with you. I know a number of you like these technical analyses when I do them. So I'm going to run through it and just point through some trends, some setups and so forth, and just kind of let you know what I'm thinking. We do a ton of macro work, and that really is really the basis for our decisions on an ongoing long-term basis. I am fond of quoting retired hedge fund manager whom I have a great deal of respect for, named Cole Moshe, and he talks about the technical and fundamental analysis, and he refers to it as the wind, which would be the technical analysis, and the tide, the underlying current, if you will, being the fundamental analysis. I think of it as the macro analysis as well. But it gets very windy in markets, and it can be that way for weeks, if not months, and it can throw things in all kinds of directions that all too often defy the tide, if you will. So important to understand the technicals, important to look at them and so on. So without further ado, financials starting at the top. And as you can see here, I just do my own subjective score of a 1 being a very poor technical setup, 10 being the best, and XLF, which is our financials ETF, which is a pretty noticeable position in our portfolio when you add it to banks, which is just a purely bank ETF, which is the next one. And so follow my arrow here. I'm not going to paint any more lines. I did enough already. But so this is the 2-year daily chart. And of course, this is when the market fell apart last February to March. And then this is the upward trend line you can see that took us all the way to September and then broke down through there, and then it was resistance for quite some time, finally broke back up there, and it had been support. This is the 50-day exponential moving average, exponential because it puts more weight on the more recent day's actions, if you will. And then here's kind of another trend line in dotted. Yellow line right here, and you can see there's multiple points here as well. So note here that I've got this looks like a flag, and this is not a bad looking bull flag pattern, and bull meaning bullish. And so the way this works technically, and I'm thinking like a technician here, understanding that a lot of people trade their stocks just based on this and their ETFs and so on. So here you have the flagpole, here you have the flag itself, and this would be a nice nice steep rally. This would be a consolidation. This can't really go much further in this way and be a flag pattern. But so what ultimately should happen, it's a fairly high probability setup, is that you break back through this resistance here, and you go about as far as the flagpole. So technicians will take this, they'll measure it, they'll put it up here, and they'll have a new price target up here. Well, this may play out actually. So you can see my trend line here, which is a pretty well-defined trend line. Today, the last couple of days we went down below it. Today we closed just on top of it. And as you can see, we have a 50-day moving average that's still upward sloping, and that's bullish. We had bearish divergences here as we were moving up. And if you put these two together, you have a rising wedge pattern, which is bearish. And just to get a feel for how bearish that is, here you had a rising wedge. Divergences in the momentum, meaning a higher high here, lower high there, and then kaboom, everything fell apart. So that's kind of what I was looking at here. However, this flag began to develop, had a nice move today. By the way, end of the day news, and banks have been up in the after hours, is that the Fed, as of June 30th forward, the banks can raise dividends if they so choose. There was a pandemic restriction on banks. And they can also resume share buybacks if they'd like to as well. And of course, if they undertake that, that's going to be very bullish. At least it was during the last bull market. So we have a fairly okay setup right here. The news today is very encouraging. Banks and financials, which includes insurance companies, brokerages, and so forth. That's about 12% of our U.S. exposure, so it's not insignificant. And here's the bank ETF as well. Doesn't look quite as good as financials by itself. This would not be a bull flag, by the way, but this is an upward sloping wedge. Just touched the 50-day moving average today. You got double support here. You have this trend line and the 50-day moving average, so that could be hard to penetrate. The news today really helps this probably to the upside. Do have those negative divergences here, though, where you just didn't have the momentum keep up with the price momentum. The way these are measured. So banks not quite as good, but they're in there with financials. They do get the benefit of today's news, I would suspect. Tech has been a problem, and that's been a problem that we've been anticipating for quite some time as it's continued to melt higher. A real classic bearish wedge, upward sloping wedge pattern. Really noticeable longer-term divergences. You can see we broke down through that as we tend to with these kind of patterns. Came back, tested the upward trend line, became resistance, fell down, crashed last couple of days through the 50-day moving average. Again, this could come bounding back, but this would be somewhat of a negative sign, and it's beginning to look kind of like a head and shoulders, which is also quite the negative high probability sign. So, and I say kind of, this would be your left shoulder, this would be your head, this would be your right shoulder. I would draw a line through here, which would be the neckline, that would be resistance and so on. So I didn't fire up my drawing tool, so maybe next time. So tech gets a pretty low score right here. Industrials staying up in that channel, kind of that wedge forming, but not quite as dramatic. Do have the bearish divergences, do have a sell signal here when the white line drops below the red line on the MACD. But, we have an upward sloping 50-day moving average, kind of holding this trend line right here. Had a pretty good day today, finally by the end of the day. So we get a 7 on industrials. Materials, like them a lot, expect big infrastructure plan going forward. That speaks well of industrials and metals and everything else as well. Holding this upward trend here, holding the 50-day moving average. Do have a sell signal. Looks better up here. We get a 6. Healthcare gave way to this upward sloping wedge, bearish divergences. Pretty good buy signal right in here, although we are getting some rolling over here. Just saved the 50-day moving average today. Give it a 5 for now. We'll keep our eye on healthcare. Don't have a huge position. Right now, healthcare is 7% of our U.S. equity exposure. Staples looking pretty good of late. We need to pay attention to that because staples are defensive, and that would be consumer staples, the things people need to buy to stay alive. And so we have an upward sloping 50-day moving average, was tested it, beat that. We did have the upward sloping wedge, broke through it on bearish divergences, but this is looking pretty encouraging. So the fact that staples are looking better and outperforming the more cyclical sectors says that there's some defensiveness right now, at least in the market. You can notice here as we had a lower low, we had a leveling out on the moving average convergence divergence, and we actually had a nice bullish divergence here on the relative strength index, and then broke through this divergence here. So a little more upside there, and you could see staples break out. I'm not making a big bet on it, but it could happen. Utilities are beginning to look constructive as well. These are bullish divergences against this flatness here. Beat back or recaptured the 50-day moving average, threatening this downward sloping trend line here. Utilities get a 6. 1 asterisk means that's an improvement week over week. 2 means it's a negative, and a negative would be for energy. So on energy, we had, again, upward sloping wedge, somewhat of a negative divergence, didn't really confirm that at a higher high. Broke down through that, of course. Now we have kind of double support here. We have the 50-day moving average, and we have this support line that goes back to this high back in June of 2000. So we'll see. I give it a 6. It was obviously higher than that. That's why there's 2 asterisks. OPEC is kind of holding with their supply cuts, keeping the supply of oil or the production of oil down to keep the price up. Beginning to question some of the demand issues. I think it's too early to question that. I listened to an analyst today really throw cold water on the energy trade. I think that's premature. I think there's a lot left to happen. People are beginning to fly in planes again, get out and about as the economies open up. So I don't think we need to be that bearish on energy right here. Energy services companies, if indeed demand picks up and if it's sustainable, under this new political regime we have, we're not going to see big build outs of new capacity, but bringing on existing or expanding existing capacity if demand calls for it is a good thing. We've done pretty well in this particular ETF since we started it not that long ago, although it is breaking down below this channel. Did break down below the 50-day moving average today, so we'll see how that plays out. In the futures market, oil futures are up right now, so we'll see how tomorrow plays out. Eurozone stocks, like them a lot from a valuation, dividend, all those good things. Relative underperformance to the U.S. for about a decade. I do think the setup is for foreign outperformance going forward. We were looking very good for a while, but we had this bearish setup, bearish divergences, so we're breaking down through there. Still holding the 50-day moving average. So there's going to be a lot of volatility. Nothing really looks great other than banks right here, or the financials to me. Also think Asia is an opportunity if we're patient. Asia gets a 5, just broke down below this trend line up here. Could be a head and shoulders pattern forming. That's very bearish. Do have a bit of a short-term sell signal here. We'll keep our eye on Asia. Pretty significant position for us. As are emerging markets. Emerging markets are really poised to do well fundamentally going forward. Technically, broke through the 50-day moving average, broke through this trend line, trying to hold support right here. Pretty bad looking chart for the moment for emerging markets. And I'm going to finish up with the currencies, and that's going to help me make sense of all this more. So here's gold. Gold gets a 6 this week. That's what I had it on last week. See the downward sloping, lost the 50-day moving average. That's bearish. However, notice we have a wedge, but we have a downward sloping wedge. Believe it or not, that's the opposite. That's actually a bullish pattern. And then we have here, this would be a bullish divergence. We have, a lower low, but we're flat here on the RSI. That still kind of confirms a negative, but that's a buy signal, and that looks like with a little bit of momentum, a little rolling over here, but that's encouraging for gold. So we'll see. Gold probably should break out from here. A lot is going to have to do with what bonds do and what the dollar does in particular, and we'll touch on that in a second. Gold miners, 10 years ago, the mining industry was not a place to be. Very debt-ridden, just bloated, frothy, if you will. Really cleaned up their balance sheets. Probably some of the best values out there in the market. Really haven't reflected the rise in metals and in gold itself, in terms of the pricing and so forth. So there's a kind of a chasm there that would have miners catch up. You can argue that I've got my bullish downward sloping wedge broke through that, but it's kind of rolling over again. So not a great looking chart. It's a 5, and obviously I downgraded it from the week before. Longer term, I do like miners a lot right here. Silver, it was great play last year. Technically, pardon all the noise here on the chart, but you see we just kept breaking down through this kind of fan pattern here. So we could have even been like a blow off top, and you can see we had this big, huge run up that day. And that was when that silliness with Wall Street bets and Robinhood and so forth, they thought they were going to push silver through the moon. Well, yeah, it worked for a day. And so anyway, so back to looking at it as a legitimate investment. This is a silver ETF, tracks the metal. A 4 downgrade over the week, but remember, silver's got some gold quality to it in terms of precious metal. Hugely important industrial metal. We're going to get infrastructure spending, no ifs, ands, or buts about it. And of course, silver is in solar panels as well, and that speaks to the current political setup. DBA, ag commodities, have been a really good position for us, but it's given back some. We were up about 25% here a month ago, still up about 19% since we bought it back in November. But we're breaking down below this very steep upward sloping trend line. And you can call it profit taking. Just barely held on to the 50-day moving average. I mean, by 1 penny today. This is rolling over here, not a good sign. Could see some more give back. I think a lot has to do with what goes on in the dollar. We want to own commodities long term here, folks. So, but again, right now the wind is kind of going against our our fundamental tide, if you will. Base metals, right? Your copper, iron ore, nickel, that sort of thing. There's your bull flag. Broke out of that, but it's rolling back over. This may end up being a failed pattern, if I even got that right in terms of drawing that. Still, we've got a pretty good looking 50-day moving average. So we've got a little space there before we test that. Not so good here on the momentum, although we are kind of flattening out here. So it'll be interesting to see. But again, you got to like this commodities fund long term, given where all the spending is going to be from the federal government. And then metals miners, right? The ones who, these are the metals futures themselves. This is the metals miners, so these are the stocks. Just held the 50-day moving average. It closed at 37.48. The 50-day moving average is 36.89. So tested that, held that today. That's a good sign. These are very bearish divergences here against this pattern. So not a good short-term technical setup. Really good long-term fundamental setup. Japanese yen, we have a small position there. It's kind of a hedge. Here's where the stock market fell apart last February to March. Look what the yen did, right? Still upward sloping wedge. Of course, we broke through that. We had the bearish divergences rolling over 50-day moving average. However, finding some support right here at 86.23. And then we've got these bullish divergences. So suddenly the yen is looking interesting. And if that corresponds with a falling dollar, suddenly, stocks and particularly commodities are going to start liking that. I like Verizon a lot as a 5G long-term play. Pays about a 4.6% dividend in our portfolios. Been a tough place to be. It is interesting. Warren Buffett, his last 13F filing, they did add a position in Verizon, and it probably was right here, so it did like that. But so we've been, had quite the sell-off. Got just back to the pre-COVID high and then gave that up. 50 days flattening out though. Came back above that with some conviction, with some momentum. Like that right in here, we were getting our bullish divergences, which are telling us that this was probably likely. So we'll see if this isn't the beginning of something bigger and better for our Verizon position. Between that and AT&T, they make up 10.5% of our U.S. equity exposure. AT&T pays a 7% dividend. Still sitting down here near its COVID low. I could speak to the fundamentals of AT&T, but just in the interest of time, we'll just keep it on the technicals. A descending triangle pattern is pretty bearish. You can see just kind of holding that line, trying to break through this resistance right here. 50-day moving average looks constructive. Not so constructive here. Give it a 5. Solar, gotta like it a lot just because of where we're going, right, over the next few years in terms of incentives for solar, wind, etc. Hasn't done so well. We just recently added it and timing wasn't so great. So it looked like we're going to get a breakout here. Maybe now it looks more like a triple top. Coming down, finding some support right here, and we're getting some bullish divergences here. So long term, this isn't a big position. Could be bigger. I mean, if we really fell out of bed here, we'd probably add to it. Whether or not we use it to do some tax loss harvesting, if we continue to flail down in here, then maybe we'll use it for that as well. But we do want to be in a position here long term, as we do when there's some big incentives. I've skimmed through, as has Ryan internally, really looked at the Biden energy plan and real incentives for wind producers, wind companies. But kind of looks like the solar chart, although we're getting some better look down in here. So we'll see how that plays out. Give it a 5, a little better rating than the week before. Water companies, water services companies. Water is a commodity that's in great demand in terms of clean, better water the world over. So a position there makes sense. That's the water ETF. Not looking so bad. It's just barely held the 50-day moving average, but like everything else out there, pretty much looks toppy. Kind of bearish in here. We give it a 5. Small position for us at this point. MP Materials, really the only viable rare earth miner in the U.S. China has had a lock on rare earth minerals. This is a newly public company. This one we like a lot. You can see it hasn't been, awesome here of late. We've made money on it since we bought it. It's had quite the fall off here recently. We were able to keep some of our gains. Had a good day today. It was doing well in the after hours. Of course, this is bearish, but this is beginning to look a little more bullish in here. I've noticed that whenever the tensions flare, trade tensions with China, this does really well. When we get softer talk, this tends to wane a bit. But it is encouraging that the U.S. has some capacity to create this stuff en masse. And this is rare earths are needed to do this presentation for you today. It's in our everyday technology, but they're also essential in the electric batteries and that sort of thing, and that's the future, of course. Uranium, believe it or not, in the Biden plan, they're very pro-nuclear. Uranium is off about 50% from its 2011 high. They're really at under amount of capacity, or a low amount of capacity relative to what happened in Japan with Fukushima. I think there's 9 reactors coming back online. Europe, they are keeping them alive for longer, and there's lots of plans, and I think there's like 50 that have already broken ground. So uranium miners should do very, very well. I think that's an underappreciated, under-recognized opportunity. So we just recently added a position there. I think we're off 2.5% since we started. Our newest position is the largest U.S. lithium miner, and also the #1 lithium provider to the EV battery space. China's got the biggest company, but this one is the biggest in the world in terms of the supply to electric car batteries, etc. Albemarle, I believe is how you pronounce that. But again, we're off. I think we're off 4% since we bought it. We bought it on this dip. Small positions, like 1% of our U.S. stock allocation. We can certainly add more if it gives us more opportunity, but broke out of this channel to the upside, but we're just kind of riding it lower. A little bit of a sell signal there. Here's a bullish divergence in the RSI, but we'll see. It'll be interesting to see how this plays out. And now I want to just look at one of the other, we track a whole slew of other sectors and ETFs and so forth. But I want to look at TLT. TLT is a 20+ year treasury, long-term treasury ETF. So this goes inverse to interest rates. So interest rates have been rising quite noticeably. So that would be the interest rates rising or the yields rising, therefore the price going down. So you would invert this and it would just look like treasury yields. This is a bullish downward sloping wedge. This is a bullish divergence. This is a bullish divergence. So we just broke out of that. If this continues, you're going to see this big spike in interest rates, or this momentum. You're going to see this turn around. So technically, it looks like this big rally that's been somewhat problematic, particularly for tech stocks. They're in correction territory. They're the most interest rate sensitive stocks at the moment, even probably more so than utilities, believe it or not. And but if this reverses, this says that we can look for better days, and certainly better days for commodities. Gold in particular is really all about real yields right now. And so when nominal yields are going higher, that means real yields, when you minus inflation, are also going higher. We have inflation, as you know. I'm in the camp that's a very unpopular camp, it seems like, among some economists who just don't believe, with all the slack in the labor market, et cetera, that we can have inflation. I think, oh yes, we can. When you've got the bottlenecks, you've got potential pickup in the economy, and we're seeing it in our index. And you've got a Fed that's not going to let interest rates go too high to offset or counter inflation. And then you throw a few $1 trillion over and over and over again into the economy. Well, you're going to see it. I know you folks are seeing it in places like the grocery store. Want to finish up, just take a minute or two and just do the currencies, maybe not all of them, but certainly the US dollar. So a rising dollar, as I have been preaching for a couple of years, as we entered this precarious setup. And remember, folks, we were beginning to hedge before I could spell coronavirus. We have a debt bubble for the ages, and we had an economy that was peaking. Probably wouldn't have had a recession in 2020 because of the election, all that kind of stuff, Japanese Olympics. But COVID made it happen, and quite frankly, COVID is a reason stocks have not done what they should have done, given the kind of recession that we were in for and the debt bubble that needed to burst. COVID gave the green light for central banks in particular to just go way beyond anything that historically would seem possible, and just completely create moral hazard like there's no tomorrow. And so it appears as though they've rescued the system, rescued the stock market, and so forth. The problem is all those excesses are still here, and I write about that a lot. Of course, I'll continue to. As for the dollar, I was looking for this bounce, and I think I talked about this to you about this as before it happened. Here was the setup. You had a downward sloping wedge with these white lines. You had the bullish divergences. It was just going to pop higher, and I'll show you another reason why I thought so. Now we're starting to wedge a little higher here. We're starting to roll over on the RSI. I'm not so sure. I'm not sure there's a lot left in the dollar. Economists who I respect think that there's a lot left in the dollar. Certainly if interest rates continue to rise, the economy keeps coming back. Maybe technically it's beginning to look suspect. If it does, look out stock market, look out commodities, and you know I like commodities, so will not look really well. On a trend basis, in a short to intermediate term basis, if the dollar continues to go, but not much else will either. And it's fine if it happens, folks, because we're long-term investors. We just have to live through, I wish it would always work out on a short-term basis, but that's just not the real world. But if we do the work and we make sure we're in the right places on a long-term basis, and we do it smartly and safely, that's what we're trying to accomplish. So we'll see. But another reason the dollar was just so poised for a breakout is because it was just hugely shorted. So this is the commitment of traders report, and these are I do the non-commercial, which are the pure speculators. So we were way short. And then we were beginning to see these bullish divergences. So you just knew if we break through a level, these shorts are going to have to cover. Spent a lot of time on that over the whole GameStop phenomenon and what these kids, as I call them, were trying to accomplish by creating short covering rallies. And that's what we got in the dollar right here. So suddenly we got this big bar last week in terms of net bulls, right? So it kind of works in the opposite fashion. This keeps going. And you got these futures traders who are net bullish, more long contracts versus short. And then, if we begin to roll over, suddenly we go right back into that short position. Understand this, to the extent that the Fed can control the dollar and open up swap lines and these kinds of things to keep it down, they will if it gets too out of whack to the upside. It's just too problematic for the debt bomb that we have in emerging markets and dollar-denominated debt and so forth. The euro is the biggest counterweight in the dollar index. So here's the euro with a bullish downward sloping wedge, although a rolling over 50-day moving average. But we've got a bit of a bullish divergence here in the RSI, not so yet in the MACD. But this breaking out to the upside would be the dollar breaking out to the downside. Be great for our commodities exposure, I suspect. And the euro is still, you can see the longs are getting lower and lower, so less bullishness as it's rolled over here, right? And that's good. You don't want, if you want the euro to go up and the dollar to go down because you're thinking about your portfolio in the short run, then these are all good developments. The yen, again, I showed you this a second ago. It was in a bar chart, but it was in a candle chart. Here's the bar chart. You can see where the yen spiked up. I like it as a hedge. We don't have a big position. Rolled over here as the dollar got stronger, but notice right in here we seem to be bottoming. These are bullish divergences, and so you can see the bulls capitulated. Now we've got net bearishness, net shorts in the futures pit. So if these folks suddenly have to cover, you're going to get a rising yen, and we'll talk about that if and when it happens. The pound, this was a no-brainer. If I were a short-term trader, I would have shorted the pound right here. You had your bearish divergences, and sure enough, we've broken through these trend lines. We'll see how the pound holds up. Not as critical to the dollar as the euro is. You can see everybody was too one-sided. We'll see how this plays out. It wouldn't surprise me to see people give up on the pound here in the near term. Why would I track the Aussie dollar? I'll stop here. Aussie dollar and the Canadian dollar. These are commodity currencies, right? So we have 24% of our core allocation is in commodities. So they tend to correlate with the Aussie dollar and the Canadian dollar and the Brazilian real and other things we track, but I'll just show you the Aussie and the Canadian dollar. So, we had this kind of channel, a little bit of a wedge in here, broke through the 50-day moving average on these bearish divergences, and that corresponds with the recent sell-off in commodities. But you can see that we've got 3 weeks of bullishness. So the futures speculators are thinking that the Aussie dollar is going to come back, and that speaks bullishly about commodities. Canadian dollar still ahead of its 50-day moving average, still trying to hang on to this trend line here. Do have bearish divergences there, do have bullishness here as well. So what the futures traders know what they're doing is they become bullish on, they've been bullish on the loonie, the Canadian dollar. That speaks well to our commodities exposure. So folks, putting it all together, there's a ton of stuff I could talk about the macro, but I'm going to do the macro update tomorrow, so you'll get that on the written blog. Not a great looking setup, at all. My concerns about the bubbleishness, use a silly term, in the stock market. It's just there. Valuations are ridiculous, but we also have a ridiculous amount of support. The powers that be are going to kill themselves to not allow this bubble to burst. Clients, I just don't want to take your money and play that game, with the FANG stocks and the tech stocks, which are rolling over. I've been glad not to own them right now. Small caps have been just screaming higher until the last, couple of weeks or so. So it just seems like everybody's playing this reflation trade. I think we should play it too, but I think we should do it in things like industrial stocks, material stocks, commodities, miners, things that actually have fundamental value, that don't look bubbly, that really play the same theme, just maybe a little slower, certainly with some counter correlations, which I think is really, really important. This just isn't the market we had from 2009 through 2019, despite if you watch CNBC. Remember, Wall Street needs to do IPOs. They need to do investment banking, which IPOs, mergers, acquisitions. A strong market is really great for Wall Street. So to the extent that they can proffer a bullish narrative, man, they're going to. We have to do deeper work than that, and we have to be smart. We have to be willing to allow the market to run away from us a little bit when the setup says that that's the right thing to do. Again, 2009 to 2019, you longtime clients, we had a really nice run, and it made perfect sense to be just all in, on the market, stock market. Absolutely unequivocally does not make perfect sense today. From a risk-reward standpoint. But we can make money in this environment. We just have to be very smart and really, really, really crunch the macro, and at least weekly look at the technicals and be prepared. There's good entry point signals there, exit point signals, that sort of thing. Sorry for rambling so long. Thank you so much, as always, for watching and listening, and talk to you again soon. Bye-bye.